Are you wondering about how best to include risk when using the discounted cash flow and economic profit frameworks? In this video, we will look at the interesting psychological phenomenon called risk, what risk is and how we can possibly measure it. In business, risks are lurking everywhere. But what is risk? Risk is uncertainty, not knowing what might happen next, not knowing what might happen in the future. In a sense, risk is not being able to know. Risk can also be thought of as a probability distribution, different expected probabilities or likelihoods of different possible outcomes. It is easy to think of risk as being the possibility of bad things happening, things we do not like or which are painful. However, risk is more like uncertainty about whether good or bad things might happen. Investing in the equity of firms is about balancing risk and return and seeking that balance in our favour. To be able to use our economic profit and discounted cash flow models, we need to forecast returns to equity investors, which is the expected future abnormal operating income or expected future cash flows. When we are dealing with the future, we can only talk about expected returns. This means we must also acknowledge the possibility of the unexpected. The possibility, or indeed perhaps the near certainty, that we might receive returns different to those we expect. The reality is that business and life is uncertain. We do not know the future, and the future will be full of surprises and of the unexpected. Risk is the recognition that we might receive something different from our expected future returns. It may be better, it may be worse. To determine a firm's cost of capital, we need to assess the risk of a business compared to the risk of other investment opportunities that might be available to investors. You may have studied finance theory. Much of modern finance theory is based on the notion that share markets are efficient and the share prices of listed companies effectively reflect the intrinsic value of firms always, often expressed as reflecting all publicly available information. In finance theory, the risk of an equity investment is simply based on the past variability of a firm's share price relative to the overall share market, and assuming this relationship will continue in the future. This is called its beta. This is the risk finance theory suggests a firm contributes to its equity investors and for which they need to be compensated in terms of the level of expected returns. See the video Risk Finance Theory for more about how we calculate risk in finance theory. A firm's beta does not directly connect us to the actual business risks of a firm. It also takes no notice of any deviation of a firm's share price from its intrinsic value. In finance theory, the risk of an equity investment is simply based on the past variability of a firm's share price relative to the share market. An assessment of the risks of investing in a firm is a key element of financial statement analysis and of fundamental analysis of firms. The risks of investing in a firm cannot be understood without us understanding the risks of a firm's business. For further information on how to analyse risk in practice, go back to Chapter 7, Section 7.3 in the study guide, and also review How to Predict the Future to Eternity questions. Also answer, write and rate questions on how to predict the future to eternity in Peerwise.